Hello, today I'm going to be covering when is the best time to sell a compounder. And just for those of you who don't know, I'm going to give a quick breakdown. For me, a compounder is a business which can sustainably grow. And to sustainably grow, that means you have to be profitable, can sustainably grow and outpace sort of market growth. That to me is a compounder. And generally, I look for a specific reason for that. So that might be just so that they have a very attractive brand and they're able to market themselves really well and distinguish themselves from competitors with a superior offering. This might be the likes of sort of Elf Beauty, Elf Cosmetics. They do a really good job at this. Another example is that they just may have a superior offering and superior technology. Palantir is a pretty famous example and has done really well in the AI space, and that's just because of the capability they've built up from the 20 plus years of just operating and chipping away at the space. They are by far one of the best offerings for large language models and other sort of models as well. And to me, it doesn't have to be that complicated as well. It could just simply be that they're in a monopoly and that they have a winner takes all sort of market dynamic, or it's a very regulated industry, or it has high barriers to entry where it needs government approval and so forth. There's many reasons. But once you've identified this company that can grow beyond market rates, it can price, it has more pricing power than the average company in the market, and you know that whatever rate it can sustainably grow, whether that's 40, 30, 20%, even 10, 15% a year, and if you know that that business can compound at a significant rate for a significant period of time. I mean, most fast-growing companies, their majority of their growth starts to diminish after 5 years. I think there's some study done where certain companies growing over X amount, I think it was 50+%, 80% of them, that growth tailed off massively after about 3 years. So I think the key here is that it has to be sustained and there is a reasoning behind it for it to be able to continue chugging away at its continuous rates. And if you are able to identify such a company, for me, it's the best I've ever done is when I've held on to these businesses and been reluctant to sell it. And today I'm going to be going over the opposite and why I think the very few reasons that if you are going to sell it, these should be the reasons. And basically, my default is if it doesn't meet these reasons, I mean, you shouldn't really be selling it. So the first one is relatively straightforward, but if you've taken out any call options or if you've taken out any debts and you think it's reaching a valuation where you're not so sure or you're just not comfortable with the debt, I don't think you should be holding that position. I think that is a valid time to sell. I mean, anything with debt, even the best compounders will do really poorly if gone wrong. I mean, a good example is everyone knows Berkshire Hathaway. That stock has compounded massively over years, particularly in its earlier days. And there is a story of there used to actually be three individuals in this. It used to be a trio of the Charlie Munger, Warren Buffett, what was a trio, and that third person was Rick Goran. And actually, what ended up happening is he bought a wonderful compound of Berkshire Hathaway, but he made the mistake of taking on too much debt and actually he was forced to sell his shares at $40 a share, which are now worth more than $40,000 per share. And that's because he found the right company. He had the timing almost right in the sense that he was buying near trough valuations, and yet he still got wiped out because of debt. So I think debt is an obvious one, or just call options, anything with leverage really. A second sort of really, I'd say a justifiable reason to sell is if you think that the business has hit egregious, egregious valuations. And this is something Monish Pabrai always says. Now, another thing he says is once you figure out what egregious is, please tell me. So I think everyone has their own definition of egregious, but for me, I think I look at my investing time horizon. So I say, well, David, I'm going to look to invest for the next 5, 10 years. And then for me, I'm going to think, well, does it make sense to own this company beyond 5, 10 years? Now, of course, if you've got a longer time horizon, or you might think, well, David, you're wrong for only thinking that short term, or you might think, oh, that's way too long. But for me, egregious becomes a point where I can no longer justify the valuation under almost any circumstance. And what I mean by that is, say that management outbeat their targets every single year for the next 5 years continuously. It was an ideal market. The world ran perfectly and smoothly, which it almost never does. which it never does. And even then, it would still be trading at a rich multiple. So, for example, is Palantir. Palantir is doing extremely well, but I think personally, it's gone to a point where you could say, well, realistically, they'd probably compound about 25% a year. I mean, considering 20, even if you go 30% a year, right, for the next 5, 10 years, which is still pretty aggressive, mind you. Even if you were to say, well, they grow at 40% a year from here on out for the next 10 years, even then, by that time, you'll still end up with a ridiculous price earnings multiple. And this is even if you factor in, a good profit net income margin. So to me, that's when it starts to become a bit egregious, when you can't see the end of the tunnel, and you can't see, well, at what point, yes, maybe if I hold it for the next 30, 40 years, but at that point, is it worth the return? I don't think so. So it really does depend. I think a good example that Monish talks about, and I think he's right to talk about, is Microsoft. Microsoft is one of the world's, if not the world's best company from a business perspective. I mean, you pretty much have all these corporations who are locked into your systems, very high retention, and you can almost charge whatever you want up to an extent. And these corporations just don't really have any other better sort of package solution offering, right? And your business is basically net is pure margins. Your only cost is basically what you pay your staff to write the software. And to be honest, the software hasn't changed much since. So your only real cost is just the general upkeep throughout the business and so forth. And in this business, I think at the 2015, 2010 period, had gotten so egregiously valued that essentially, had you held it for the next 20 years, you basically, from that peak, you basically would have come out break even, perhaps a double over 20 whole years. I mean, you basically could have put your money in a savings account and had a better return with a heck of a lot less volatility. I mean, we're probably talking more than a 50% drop at one point because of how egregiously valued this company was. Pepsi has reached similar, I think they reached like 80 times earnings at one point. So there are, Coca-Cola. So there are definitely periods where these businesses hit these sort of egregious highs. And I think to me, that's justifiable in the sense that you look out and you say, well, I really want to hold this business because, again, great businesses surprise to the upside very often. And you think, even if they surprise to the upside and even if everything goes perfectly for the next 5 years, I don't really see myself making money. I see it trading at where it is now. So that means that actually, when you look at it from a probability perspective in terms of risk reward, you're actually a lot more vulnerable to everything else happening below than you are for any, you might have to be the equivalent of a mask manufacturing company in COVID to really see like that one in a million freak scenario to see yourself actually gain any more upside than it's currently trading at. So I think that's sort of when it becomes fair to sell it. Now, it's obviously hard to tell if a business is early days, and often, like I say, great businesses have a way to surprise the upside. So I think for me, I have to be really, usually I'm very conservative in these calculations, but I think when I go to sell, I should really be the opposite, where for me personally, I should be very relaxed and think, well, be very generous with this company and think, well, it's a truly great business, assuming you've identified that. And think, you know, I don't want to sell it too early. Be reluctant. I want to be reluctant to sell it. But even if I'm reluctant and it's trading at such a valuation which I can't, even in the best case scenario, justify it, then I'd probably go ahead and sell. So they're the first sort of two reasons. Other reasons are just because you see a structural decline in the business. I mean, it doesn't have to be the decline, but the business just perhaps doesn't have the same moat it had. I mean, for me, Tesla at some points didn't look to be the same business because, yes, they still have a great culture. Yes, they still have a huge technology advantage with all the driven miles of data. But let's be honest, at one point, Elon, and you could argue still nowadays, has become quite distracted in the sense that for a business genius to be running 2, 3 businesses already quite a tall order. But for you to see him, yes, you can say he's not directly involved with everything all day, every day. But at the end of the day, it's his mental bandwidth that's being taken up. Whereas great ideas come from where he can allocate his attention to. And for him to be running 5, 6 companies and then getting involved in the American politics scheme as well, that to me starts to, when he's the crux of that business and the quality behind it, starts to me look like a degradation in the quality of the business. Now that's very nuanced. You could say, well, a good example might be a railway business has historically done very well because there's been no other competitor. So coal companies who have transported this coal have basically had to pay an arm and leg to travel and move this coal because there's no other cheaper alternative. Transporting by rail is still going to be significantly cheaper than by truck. But then what if you figured that, well, actually, what if you found out that there had become more affordable alternatives? For example, a port had just opened up nearby and this could compete with their pricing power. And lo and behold, this business isn't as secure as you thought. There's various nuances as well. Perhaps it could often be stemmed from management. It could often be that what used to make them special started fading. All the technology advantage they have is now outdated or doesn't apply as much. That to me can also be a good time to consider selling when you see it in decline. Again, I'd be a bit reluctant to do that immediately at any jump because there's always going to be new scares. Meta Facebook was meant to have been finished years and years ago by multiple schemes and whether that's being broken up by sort of the government, whether that is, antitrust regulators who are, or sort of any lawsuits against them where I think it was the Cambridge Analytica scandal. There's multiple instances where you could look back and say, well, they were pretty much done for. So I'd be a bit reluctant to do it immediately again, but that I would say is a valid reason. So for me, they generally come under the bucket and just perhaps the market is starting to tap out.